Tell us one more time how it works. So you don't take any money up front. You get a percentage of like how does like tell me your business model real quick.
Yeah, that's basically the business model, is that whatever we get you, personal credit cards, business credit cards, SBA loans, whatever it is, we charge you when you receive the money from the bank and not until.
Is that percent that you take on a sliding scale relative to your level of risk, or how does that work?
No, we're not at risk, but it's level of difficulty and size. So, we're going to charge a lot more for 100,000 than we are for 1 million. But okay. What happens is a lot of people start with us at the bottom and they grow. So the client that came to me for 100, I got him 150. It might be 1 year, it might be 5 years, but 5 years later, I'm getting them $1 million loan. Again, sometimes that might mean $100,000 loans, not $1 million loan, depends on what it is. If it's an SBA loan, it might be $1 million or $2 million because we're buying a building now, so we're converting that to a real estate loan, which we love.
What? Go ahead.
But we just charge when you receive money, that's when you pay us. You never pay us otherwise.
This episode made possible by Restaurant Systems Pro. With excitement, allow me to introduce to you today's guest, founder and owner of funding.com, Michael Praver. My man, Michael, are you feeling unstoppable today?
I am, Eric. How are you?
I'm great. And, you came into my life. I saw this email from you. My audience, my community was asking me to go deeper into the world of funding. And as somebody who has interviewed hundreds, if not over 1,000 of restaurateurs on advice on funding, is probably one of the most there's a lot of contradicting advice out there, and it's like you need the money to grow, but you don't want to get over your skis. There seems to be this very fine balance, and there's a reason why there's experts dedicated to the subject. So I try to tiptoe around the subject because I've heard so much contradictory advice. Today I want to get your perspective. I want to get I'll probably get some perspective from different companies that are out there. Like In Kind is another company that's doing some really interesting things. I can't wait to dive into it. But today we're going to talk about types of funding at startup and through expansion to 3 locations. Before we get into it, what's that inspirational, motivational success quote you have for us today to get this thing going?
It's funding for people on the grow. That's what I'm looking for. People that are growing.
Okay. Why is growth so important to you?
Because it all comes back to funding. I see people all the time that attempt to start a business and they think they could make it with a certain amount of money. And essentially they're, in my opinion, out of business before they get started.
Right.
Because one day that you do not have enough money, your business is closed. So if it takes you 6 months to prep and you're out of business, you're out of business. If it takes you 1 year, you're out of business on that one day. And I don't want that to happen. I want every business to have a reasonable shot to find out if the concept and execution could work. And running out of money is the worst possible reason to not find out if your business was going to be a success.
Right. Number one reason why restaurants fail is because they're undercapitalized. Fact.
All startups. Yes.
Yeah,
absolutely.
So, and it's interesting because I feel like the timing on this conversation is good. A long time family and personal friend of mine, Jeff Gaudet, is going to be a future guest on the show, and the conversation is going to be redefining what success is. And I think part of the issue is we define success in this country as how much money am I making, how big is my business, how many locations do I have, and when you put those types of things ahead of actually doing the thing that you love to do and being good and really doing work that is meaningful, that fills your purpose, that is what people you love. And I think we can kind of get over our skis sometimes. And I think part of the secret to funding is starting small, right? And I think you help people start small. Isn't that part of a lot of the majority of the people that you work with?
Absolutely. I would say more than 9 out of 10 of our clients are coming to us at the startup point. We want to be with them for the rest of their lives. It's not contractual. They choose to continue to work with us. But yes, they're all coming for, 75, 100, 125,000, or whatever the startup is for their business. And then they stay with us because we've proven ourselves.
Yeah, that's a good segue into kind of like help us better understand like what is your work today? Like really get into what it is that you would say you specialize in and your business's portfolio, thing like that.
It obviously from the name, it's funding, but honestly, we're more into education than anything else. I would say that 90% of my day is evaluating and educating the clients because often there are two, three, four options. And these are often products that people don't have or don't understand already. Even if it's personal business, personal credit cards. Well, what's good about personal credit cards and what's bad about personal credit cards? Because there's a good and a bad to everything.
Right.
We explain it, lay it out. We might find out that a client qualifies for five types of funding. Well, we could probably do five types at once, but more likely, of the five types they qualify for, these two or three are desirable to the client.
So you don't just help the clients get find the money, like what are your options, but it's also educational. Like once you get it, how do you use it? Also, I remember you saying you do a lot of education with how do you get into the position if you're not qualified for getting funding? Like what can you do to get qualified?
Oh, that's a great topic, and one that's important to a lot of people. I'll just give you a couple of the preps. So, one is use a different person, a family member, friend, or business partner, because sometimes the challenge is not credit in the traditional sense. It's just you're overusing your credit. And the easiest way to fix the overuse problem is, like I'm doing right now, some guy came to me for funding and I could get him a lot of funding, but he has to pay down his credit cards and he can't. So I'm going to get his wife funded. Well, his wife has less credit. I might only get her $50,000, but he only needs 30,000 to pay his down, where I could go get him two or 300,000.
Right.
So the most obvious is bring another person. But beyond that, we do have, I don't even like use the word, but credit repair. We don't do it ourselves. We outsource it to a company, but we do have credit repair. We have credit enhancement, which is often using something called authorized users, which we have a couple of companies that'll rent them to you. But again, we rather go to friends and family because it's free. You get yourself on your mother or father's credit card. I don't care how old you are. Older people often have very, very stable credit. And you get yourself on a 10 or 20-year-old credit card and you're golden. So there's repair, there's enhancement, there's fixing your birthday, your job, your address, and the exact spelling of your name. We do all these things for free, but don't think those are not important. They are vital because this is all done by computer today. This isn't a human job anymore. It's preparing the client to be accepted by the computers at the banks. So someone can't have an address. I had a guy on South Beverly in Los Angeles, and South was spelled three different ways on his credit report on three different bureaus. That's three different addresses to a bank.
Right.
That's not one address. It
Yeah.
can't be SOUTH and SO period and S no period. That's just three separate addresses. No bank that I know of could look at that and say, "Oh, that's the same address."
Yeah.
But even a child could look at that and say, "Oh, that's the guy lives at this address."
Yeah, great examples of how AI isn't necessarily like the all one-stop shop solution to the world because they can't think
Can you
critically like that, you know?
Yeah, it's like when AI first came out and it couldn't spell, was it apple or no, it couldn't spell strawberry, you know. Um it's sometimes the smallest thing. If you ask AI is looking for an exact match on three
Exactly.
different
It's
addresses. It
just
doesn't.
reading what's out there. It's getting better, but it's still got some work to do. So I just want to summarize real quick. Up to this point we discussed, we're going to get into how do you get the funding if your credit's good. But you do go if you start to work with somebody, if you have a client that comes to you, you're just saying, okay, well, here's where you need to be in order for us to help you, and here's how you get there. right? That's kind of where it starts. But before we get into what we're really going to get into today, which is what are the best ways to get funding at startup and at scale, what were you doing before this? Like, how did you get to where you are today? Like, how did you find yourself doing the work you're doing today?
Great question. I really fell into this. Okay. So I'm a former commercial real estate expert, and then I gravitated towards investment banking. So I was an investment banker working for some smaller companies in Boca Raton, Florida. So southern Palm Beach County. And I ran into someone who was dealing with mortgages, or actually defaulted mortgages. And I liked helping people and solving kind of puzzles. And so what I started doing is about one, then I bought four, then I bought nine. I started buying broken mortgages. Then I started buying 30s and 50s and 100 from the likes of Bank of America and those kind of companies. Because banks know how to make a mortgage, but if it's not being paid, which is broken, they don't know how to fix it. They have a bad relationship with the borrower. All they do is call the borrower, and the borrower hangs up on them. And then what do? They have no other plan after that. So I was buying defaulted mortgages and fixing them, refinancing the house, which refinanced me out because I was the mortgage holder, or whatever the scenario called for. Sometimes people just wanted to move to another state, and I would send them an envelope, a FedEx envelope with $2,000 and a return envelope to send me the keys, and they'd sign some paperwork and send me back the keys, and they were on their way. And I took the house, and they turned the house over to me, and I sold it. And
You were just helping people with getting out of their, helping them develop an exit strategy for their debt.
yes, I call it a workout. We were working this problem out, whatever the workout was.
Right.
Sometimes it was refinance, sometimes it was cash for keys, sometimes it was just putting them back on a plan. So they owed $10,000 worth of back mortgage payments.
Yeah.
I wouldn't charge them anything. I would say, okay, yeah, great. You owe me $100,000 because I'm the lender, but you owe $10,000 in back. I'm going to throw that away. Do you have a job? Can you start paying me now? Right. That kind of, we just work out the problem. And I loved that kind of back and forth. And then comes 2008. At 2008, I owned 296 mortgages, so nearly 300. And the bottom fell out of the market. And literally, I got a couple of calls for startup businesses, in particular gourmet food trucks. So they were really people that didn't understand what we did and accidentally called me up and asked me to help them fund a startup business. And I told them we didn't do that. And then I looked at the statistics and realized there's nearly 400,000 businesses that attempt to start every month in the United States. And I said to myself, well, if I could fund even a few startup businesses out of that 400,000, I'll never run out of clients.
Right.
And that's where this was born.
Okay. And it's also never going to run out of clients, but also high risk investments.
Yes, but I didn't do it in a way that caused me to have any risk, because what I did is I solved the problem. I helped those people borrow from the biggest banks in the country, but they weren't borrowing from me. They were borrowing from the banks. So if they went out of business, I didn't want them to, but I couldn't stop them from going out of business.
Right. But you can also help set them up for success.
The number one reason that they don't go out of business is they have enough to get traction. So having enough money is the number one, but they also had me, and I talked to so many people. If they needed an accountant, if they needed a bookkeeper, whatever they need, if I know someone, I'll help them. I'll introduce them.
Right.
I talk to startups all day long. It's what I do.
Yep. So, anything we need to know about you in terms of kind of where you are today before we get into, the actual topic we're here to discuss?
No, I've been doing this for 15 years. Most of our products don't have an upfront fee. So we've never had a complaint in 15 years because we go do the work and then you get the money and then you pay us a fee. So you're only paying for what you received. And we're on the same side as the borrower. Eric, if you were starting a business, we would go out and get funding from the banks. I'm not the bank, it's from the bank. In fact, if it was smaller dollars, the bank wouldn't even know we existed. So we do it on your behalf.
Got it.
So we're working kind of together at this.
What up, unstoppable restaurant owners and operators? We have to interrupt today's video to let you know that Restaurant Unstoppable and Restaurant Systems Pro, we're taking our relationship to the next level. Beginning in July of 2024, Fred Langley, CEO of Restaurant Systems Pro, is making himself available once a week in Restaurant Unstoppable Network to answer all of your restaurant systems questions, whether it's the profit margins. He will look at your P&L. Bring your P&L. He will take a look at that. He will dissect it. He will help you find your profit, whether that be through budgeting, inventory management, costing recipe cards, labor, checklists, you name it. He is a master on restaurant systems and he's making himself available to you. Fred Langley and Restaurant Systems Pro started as a consulting firm, and for over 16 years, they've been helping their clients increase their profit by 10% or more. What are you waiting for? Click the link below to join our Facebook group, Restaurant Unstoppable Network.
If we just get right into what are the types of funding for startups, like if I'm a client, I have decent credit, but I'm not making a ton of money. I don't have a lot of money behind me, and I'm looking to raise $75,000 to cover my costs to get into, I don't know, whether that be a food truck or maybe it's a ghost kitchen situation where I need to cover like my first year of operational expenses. Like, what's your advice to me?
Well, first thing we do is talk to you generally. Then we'll have a more specific talk, usually, which would be on a video call with a review of your credit. Because I don't ask the client how is their credit. I have to look at it because I'm looking at 100 different points of data on that credit report. So we end up doing it as a lesson. Okay. So they leave that second call or third call with more knowledge about their credit than anyone they know.
Let's say I have a credit score of 675. It's not horrible. It's not great, but it's over the threshold of like people are willing to talk to me. Or is that too low, do you think?
There are 70 other data points I'm looking at, but that's not bad. But it depends on what makes up that 670. It's not a number that matters.
Right.
But 670 is pretty good. So first thing we do is look at your credit and find out what you're capable of. If you're capable of 3 different programs, then I'm going to go through those 3 different programs in exhaustive detail. Here's what's good, and here's what's bad, and here's what you could expect, and here's about the amount of money we can get you from each of those 3. If it's 3, or if it's 2, or if it's 1, we're going to go through. So I will tell you, when you said 75,000, the first thing that comes to my mind is that if I can get you 75, then we're going to have a conversation. But during that conversation, if I can get you 150, I am going to attempt to persuade you to take more, because more is better. Simply more is better, because you don't know what's coming around the bend. You don't know what the opportunities are. But I know if you don't have the money, you can't take advantage of those opportunities. So I'd rather you had more money than less. So if you want 75 and I can get it to you, great. But I'm going to beg you to take 125 or more if I can get it for you.
Got it. So before we hit record on today's conversation, we tried to achieve alignment here. What we're going to discuss. You gave me 1, 2, 3, 4 talking points in terms of what types of funding for startups. Those talking points: business credit card stacking, personal loans, SBA, no personal guarantees, were the 4 bullets you gave me. Where does it make sense to start?
Let's just skip the non-personally guaranteed, because that's another show. Okay. That's what people are going to climb through the wire and want to talk to me, or want to talk to you and me.
Tell me, just define what non-personally guaranteed, like in as simple and short of a paragraph as possible, just as a teaser.
I could now get startup businesses up to $750,000 in funding in 90 days with no personal guarantee. That means if, God forbid, everything goes bad, COVID comes back, they have to close their restaurant, they've already spent a lot of money, they close the company, they do not owe the money personally. The money was just against their business.
Okay.
That's no personal.
And you recommend this as an option?
Yes, but there's an upfront fee, and that's new for us. So I'd rather get people conventionally funded first. If I brought you 100 and you chose to use part of that money to do the non-personal guaranteed program, that's fine. But I don't want you doing it with your money out of your
How
pocket.
much money out of your pocket would you expect to spend for that?
Up to 35,000.
Okay.
Up front though.
So there
it's
is
up front.
So there's a risk. You're minimizing risk by putting the upfront cost. Is that essentially what's happening?
No, I'm minimizing what's coming out of your pocket. I'm not. It's not risk. It's just if you have $35,000 in the bank and you spend it, now you have nothing in the bank. That makes you very vulnerable. I don't want you to be in that position. I want to go get you 100 or 200, and if you want to spend the 35 in that additional program, then you do that with money that I brought you.
Let me know. Yeah, let me know when you want to go deeper into this after you've done a couple more, because I'd love to pull that.
It's going to be fun. That is going to be a fun conversation.
I'd love to learn more about that. So, next on the list is stacking personal credit cards. Sorry, business credit cards. Stacking business credit cards.
Personal and business credit cards, stacking is the same thing. It just means a stack of them. So each lender kind of thinks you're only going to them. That's their assumption. There's nothing wrong with going to 10 banks at once, but if you tried it, you might get away with one or two. If we tried it, we may get away with 10. Because we know a lot of things, including what order to do them in. And remember, we're prepping you better than you could prep yourself, getting you ready to get approved. Because we're not going to do it unless you are really ready for we're not looking to get you one or two approvals. We're looking to get you as many as humanly possible.
Okay. On average, how many approvals would you get a business stack of credit cards?
Up to 7 each company, and some people have 2 or 3 entities, LLCs. So if we apply for 14 because you have 2 LLCs, we're never going to get 14, but we could get somewhere between 5 and 12. Because each person's going to qualify differently.
Got it. So with each credit card, you're getting approximately how many? Like, what's the total amount on those cards?
The maximum that they normally will give you is $25,000 per. Every credit card in the country goes to $100,000. But when you first apply, you're having a new relationship with a new bank. So if we can get you to 25, they're not going to go to 50 or 100. Initially, they're mostly going to be up to 25.
And you said you would do this up to 7 times for each company?
Yes.
So we're looking at, $150,000 or no, $175,000.
Yes, but if your largest credit card was $4,000 and your credit was iffy, it could be $50,000. Now,
right.
even if it's 50, even if we get you $5,000 credit cards, that's only 25,000. 6 months later, each one of those is 10, 10, 10, 10, 10, then 20, 20, 20, 20, 20. It grows over time if you allow us to do it. So, but if your credit is very good, you come to me with a $75,000 credit card in your pocket, they're not going to give you 75. They normally won't give you more than 25 to start because it's a new relationship.
Got you. And typically, where are these credit card percentage rates right now on business loans?
I was going to say, talking personal or business. Business credit cards, you're looking at, I would say, because rates have come up a little bit, I would say 11 to 16, 17%.
It's pretty high, isn't it?
Yeah. It's higher than you would probably prefer, but you're building a business relationship with the 7 biggest banks in the country. That's one benefit. You are getting 6 to 12 months of no interest. Remember, they're giving you a period of no interest. So that's after the no interest period. And the other advantage is a credit card is a line of credit. That means you're not receiving the money, you're receiving access to the money. So if your interest rate is 11%, but remember, that's not for 6 to 12 months. So it's basically free right away. And you're using only 10% of those cards, 20% of those cards, you're only paying for what you're using. So there's a lot of upside to a business credit card. Remember, it also doesn't show up on your credit. So if 1 month you're using 99%, the next month you're using 0%, your credit score does not change at all because it does not show up on your personal credit.
Got it. So that's why it's important to really, develop that business entity, go use the business entity, whether that be an LLC or a C Corp or whatever, so that the business is taking on the liability of the loan, not your personal credit.
Business credit cards, I'm sorry, are still personally guaranteed.
Okay.
Even though it's a business credit card, it's the business name first and your personal name second. So you're on there. But what you're doing, I just hung up with someone yesterday who like really loves his debit cards. And I'm like, well, great, you have 12 debit cards, super, wonderful. But you're not building a business relationship. So you're putting hundreds of thousands of dollars through your debit cards per year. But your personal credit cards are $5,000 credit cards, and you're not building personal credit or business credit, even though you're doing everything properly to build that, because instead of using business credit cards and personal credit cards, you're using nothing but debit cards. Right. Yeah, not to mention the airline points and the cash back and all the other things they throw at you.
Got it. So we've covered business credit card stacking. What is the next thing after that you would advise somebody to do?
Personal loans.
Okay.
Now, I'm not going to ever recommend personal loans when you're outside of the startup phase. You and I are kind of talking about startup right now.
Right.
So if I could explain what a personal loan is for your listeners. A personal loan, I consider basically a car loan without a car. So similar to a car loan, it's a 2 to 6 year loan. It's a loan. That means they give you all the money at once, be it a wire transfer, a cashier's check, whatever it is. They give you all of the money at one time. And that also means you're paying for the money all at the same time. So 30 to 45 days later, you're making your first payment. You will have an even monthly payment, just like a car loan. That's what I'm saying. It's similar to a car loan. And where it sits on your credit report is similar also. So if we were looking at your credit report, Eric, the first section is the scary part for the banks. That's called revolving credit, basically credit cards. The second or third section is where your car loan and personal loans would be. So they're considered the same kind of product. They're not a scary product for the banks. It will bring down your credit score a little bit because you have a bunch of new loans, but there's triggers. 3 months later and 6 months later, the negative goes away. So it really has to do with new credit, not the amount of credit you're using. It's just they have a bunch of brand new loans. So it's going to bring down your credit a little bit temporarily.
Got it. Any specific concerns or warnings against personal loans?
Well, all the products we've talked about so far are personally signed by you. That means you have personal responsibility, or basically, if you don't pay, you're going to ruin your credit, your personal credit. The only other negative I can say about personal loans is that unlike business credit cards and personal credit cards, by the way, you're taking all the money at once. And people come to me and say, I need $100,000 And that's great. But sometimes I talk to them 3 months later and they've only spent 7,000 of the 100. So there's a bunch of money sitting in their bank account that they're paying for, but they're not using. Where if it was a line of credit, sort of like a business credit card, you're only paying for what you're actually using.
Right.
So the big problem is that it shows up on your credit. The smaller problem is you're taking all the money at once.
Got it.
But we're in a position where the economy might go down, and I'll tell you, there's another advantage, and that is during a recession or scary times for the banks, they sometimes pull or reduce a line of credit. So you could have a $500,000 line of credit, or you could have a credit card. They're both lines of credit. But if you had a $50,000 credit card, you wake up the next morning and now it's a $20,000 credit card. You had no say in that whatsoever. You paid us for 50, by the way, and now it's 20. It could be 6 months later or 6 years later, but they just lowered your limit.
Right.
And I've had people call the bank and get the limit back like that. I've had other people call the bank and it was absolutely no go.
Yeah. So go ahead.
But that can't happen with a loan. If I get you 4 $25,000 loans and they wire the money into your bank account,
It's your money.
It's your money. So again, that's another.
There's pros and cons there. So the pro is like once you get approved for it, it's yours. They can't take it back. They can't redact that. The con is that you're paying interest on that amount of money, whereas with a credit card, you're only paying interest on what you're actually owe at that moment.
You bet.
Got it. Those are the big takeaways. Anything else to mention relative to business credit card stacking and personal loans before we dive into the third thing that you recommend?
No. That is the third. Remember, there was personal credit cards and business credit cards, but I'm leaning towards business because personal all shows up on your personal credit.
You also said the personal loans, which is separate.
Right. But business credit cards, personal credit cards, and personal loans, those are the three that we use most often. There is an SBA loan. Getting approved for SBA loan is not absolute,
Well, that's something I'm curious about because I was under the impression to get an SBA loan, you really need to be in business for a period of time. Is it 5 years? And then show like there's like things you have to prove. But I guess there's more. Like, I'm not an expert on finance, clearly. So
I'm not the SBA expert, but I am kind of the one who explains it to clients before we bring in a real SBA expert.
If I'm a startup, I can go to SBA and there is an option for me. What is that?
Absolutely. It falls under the 7A program. So when we do big SBA loans, 500,000 to 5 million, that's called a 7A loan. But under the 7A program at the SBA, there are some smaller programs. They're called, one is called an express. I think there's two different names, but they're just two different sizes of loans. So they'll go all the way down to, I think they go to 50 or 25,000. That's how low they go. You can do it for a startup business. You're going to probably have to have decent credit or a little equity in your house. We don't do them for the clients because they're really made for the clients to do themselves. But SBA loans are not a sure thing. Okay. You could apply for an SBA loan. If it's an express loan, it's not going to take that long to find out if you get approved or don't get approved. And if you get it, wonderful. I'm thrilled for you. And we didn't take a fee. But until you get to, let's say, 500,000 and above, that's where we get involved in the SBA loans.
Got it.
But they are absolutely can be used for a startup, but you might have to have better credit or some money, like you're putting in part of the money and they're putting in the rest. So it's not quite the same as starting with us.
What does 7A program mean again? Like you said that
it's just a division under the there's a 504, there's a 7A. They have multiple programs at the SBA. And if I could throw in a couple more things. So the SBA, we discuss an SBA loan as if it's a loan. Big SBA loans are not a loan. they are a loan guarantee. So we have to bring a bank and the SBA. The SBA is guaranteeing that the lender won't lose money. That's why you are paying less for it, because it's basically further guaranteed by the federal government. But you still need a bank. So you need a bank and an SBA together. The smaller ones, you could go straight to the SBA. And that's the express loans.
So the SBA in kind of some senses is serving as like a friend or family to co-sign. They're kind of like that entity that is putting their I guess
Yes.
their influence, their credit, their presence tied to that loan to help guarantee it.
Right. But they're also keeping, they have a lot of influence on the banks, as you can imagine. And they get to sort of dictate how the loans are going to go, because they are your, in a sense, guarantor
Yeah.
or co-signer. So the lenders can't compete for rate. The rate is the rate. Whatever the rate is, it's the CPI or the prevailing interest rate plus a fee on top is what every bank has to charge. So the banks aren't saying, hey, come to us, our SBA loan is a little cheaper than the next guy. So the federal government is kind of using this to make it very homogenous. To go from one bank to another is very similar. But we still are going to help you pick a bank that is the most aggressive, that is the most in line with your product type, that is the most appropriate geographically. So, if you're in Southern California, there may be a bank in Utah that theoretically does Southern California, but honestly, they really want to do Utah. That's not the right bank for you. So we'll literally help you pick a bank. And when I say a bank, sometimes we use non-bank entities where we're going to former investment bankers who bought a banking license that you couldn't find. They don't have a physical location at all, but
Got
they want your type of loan, and we're going to bring you right there.
Got it.
So, and they only make money they make money if you get the loan.
Got it. Got it. So, just to summarize, 7-day program, Express Go down to 50 or 25K. You need decent credit. Can you define decent credit? Like what in today's world, what is decent credit?
No, because when I say decent credit, I'm talking about kind of a fundability scale. And most people think, oh, we're talking about a score. The only place a score means anything would be like a car dealership. A car dealership literally will look at a score. Everybody else, every other bank's computer looks at every detail of your credit. So I could have two people at 700. One could get anything in the world, and one can't get anything, but they're both the same score.
And it's probably relative to the debt to income ratio, right? Like you might have great credit,
there's many factors.
Debt, right?
There's late payments. You could have a late payment from 5 years ago that they don't care about, and someone else could have a late payment from last month.
Right.
The guy who's a late payment from last month is out of luck.
Right.
Because it's too new. I mean, they're not going to
likely haven't recovered yet.
But your score is the same.
Right. Right.
So how is it about a score? It's not. It's about all the details. And that's why we go through literally line by line people's credit. I'm doing it to find out how fundable you are, but at the same time, I'm teaching you all about your credit.
Yeah. So to summarize, if you are a startup and you're looking to get funding, your advice is to start with a business credit card stacking approach. If you can't get what you need with business card credit stacking, then you do a personal loan or personal credit cards. And if that can't get you what you need, then you go to SBA loans. But if you can't get the business credit and the personal credit, do you think you would qualify for an SBA loan with your credit score? Or do you think that the likelihood of you being able to, if you can't get it at that level, like will an SBA entity be able to help you?
Sometimes, because sometimes you might have equity in your house, and they'll take the equity and consider that a contribution.
So if you get to the point where you start leveraging equity, that's when you might want to, if you're willing to go that far, then reach out to the SBA. Is that
Yes.
advice?
Yeah.
Got it.
Well, I mean, we're obviously you're working with us. It's a little more sophisticated, but one of the things that we do that no one else does, you might come to me. I mean, I'm giving you exact scenarios that I've done. You could come to me for a $3 million SBA loan, and you have a completely paid off house. So you have a house that's worth $1 million and you don't owe a penny on it. Well, the problem is when we go to the SBA and they find out that you own a house and you have no mortgage on that house, they're going to say, yes, we'll give you your $3 million SBA loan, but we want a lien on your house. So what we would do, if you were willing, is bring you to a mortgage broker and get you a $900,000 loan on your $1 million house. So then when we go to the SBA says, there's not much equity left. We'll just give him the loan without taking a lien against his house. So you didn't need the $900,000. But if we don't put a lien on that house, then the SBA is gonna.
Got it.
I mean, these are the things that
experience.
Without that guidance, no one's going to give you that help.
Great stuff. Okay, so we covered the first section of today's conversation where we're focusing on startups. Now, we have gotten to the point, we had success with the initial capital. In my experience, there tends to be 4 clear points of evolution for a restaurateur. It's I'm opening a restaurant. Like that's, and opening to running a restaurant, getting to the point where you can get that first location profitable enough to scale to 3 locations. Then at 3 locations, it's a different game because now it's a matter of I really need to build layers between me and the work and remove myself from the business so I can work on the business. Or maybe if I'm opening, 2, maybe I got to my second location, but I want to get to 3 and 4. And I want to do it fast because now there are copycats out there and there's a little bit of pressure to scale quickly, but I don't have the liquidity to do it all at once, right? That might be where you need to go get maybe a couple $1 million, right? Quick to scale quick so you can kind of capitalize on the blue ocean effect of being first to market. So
you bet.
I'm just painting a random scenario, right? The other points of evolution tend to be, okay, I went from 1 to 3, then I went to 4 to 10, and now I have something that is scalable. I've proven the concept, and I could go to 50 locations, regionally,
But that's when you bring in private equity or some other technique.
Now you need millions and millions of dollars to cover all that, all that liability, the additional liability from the payroll. Now you have to hire a bunch of executives. So it's another point of evolution. We're just going to be focusing on that second phase right now, where it's okay, we have something. I need a little bit of extra cash to scale locally. What's your advice? Where are you going?
Are you talking about when you go from 3 to beyond?
Expansion, yes. And we're at we started, I'd say getting to 3, right? We had the money, we got proof of concept, we have business credit now. What's next in terms of advice on how to raise capital?
Well, okay. There are we offer business loans. So we could get you a loan on your business. But we might do an SBA loan. So a real SBA loan, the kind that we're going to help you with, is usually $500,000 and above. And they want real proof of income. So you have to have 2 years tax returns, which really usually means 3 years old, the company, to prove who you really are. Because without that, they're not going to do anything. Or you're buying a business. And I know that sounds funny, but let me explain what I mean by buying a business. You have 3 restaurants, you want to go to 6. Sometimes there's a similar restaurant out there, or there could be a Chinese concept that's going out of business or that you could buy very easily, and you could easily change it to your whatever it is, burgers, whatever your type of business is. So the advantage to buying 3 restaurants, to move from 3 to 6, buying 3 restaurants that are operating, it would be a lot easier to get an SBA loan. And you could buy a Chinese restaurant and turn it into a French restaurant,
Right.
because it's still a restaurant.
Yeah, what you're talking about right now is lowering your risk by going to a turnkey operation. You don't have to get in there. It doesn't have any new permitting, that like everything, you know that you're good. You don't have to rip up the floors. You don't have to put new electrical in. You don't have to replace the hood. You don't have to replace the plumbing. There's no construction. You're moving in.
Right, but you could maybe keep two of them operating, and the third one you're converting to yours. Then you convert the fourth, then you convert the fifth, or whatever it is. So
You're saying
you might not have to do construction all at once. You might be able to do it in phases.
so what we've covered in terms of expansion, there's the conventional business loan, and then there is the SBA up to 500,000. What is that? Is that just a conventional SBA loan? Like how? What would I refer? How would I reference that?
Yeah, it's a 7A loan. It's a regular 7A loan. I mean, you'd be doing it with our help and guidance, kind of like talking to you about getting a mortgage broker in to refinance your house, even if you didn't need it, just so the SBA wouldn't ask you for a lien on your house. Those kind of techniques you're not going to find anywhere else unless we guide you through it. Yep. And we don't charge up front, by the way. We do this where we get paid on the back end. So you're not paying us for any of this help unless you are
We'll get into
funded.
what that looks like. I am curious, but I was holding off on that. So, in order to get a standard 7A loan SBA for approximately, say, up to 500,000, you need to show at least 2 years of tax return or IEB in business for 3 years. What are the other parameters that what else you need to show?
Well, I'm gonna kind of twist that around for you. You don't have to even have a job if you're buying 2 or 3 restaurants, but they are profitable. They're not going out of business. They're profitable, at least stable. You can buy them and essentially buy your way in. You're still going to have to come up with 10% down payment. But let's say it's $1 million sale of 3 restaurants, and you're taking over the leases, you're taking over everything. But in those 3 restaurants, they already have stable income because the SBA is all about income. Then you're really trading on the reputation of the thing you're buying, sort of shifting it away from you. So it's not that you're walking in and saying, I'm qualified to buy $1 million small restaurant chain. No, you're not. You're qualified because the thing you're buying is qualified. Does that make sense?
Right. But you're
just a different way of thinking of it.
Got it. We kind of jumped right over the conventional business loan. Would you, if you are, would you say that a conventional business loan is something that you would probably approach after doing the 7A SBA loan?
It could be before or after. It depends on where we were in our kind of life cycle, and we'd have to talk that one out. But
what kind of variables would you be looking for to decide whether or not to go with a conventional business loan or a 7A SBA loan?
If you were buying a business as a startup, meaning you didn't already own them, you were just buying them, then it's a loan. You come to us after the 7A. We do the 7A first.
Got it.
But because you don't own the business yet, you can't do a loan yet unless you own the business. But when I say standard or conventional loan, I want to make sure you understand. If we did it for you, let's say you could get a $25,000 loan, we might get you a $50,000 loan. Well, 50 is better than 25, but that's not why I'm saying it. We might get you 5 of them on the same day. So it's $250,000. Again, in that case, it would be using a technique called stacking, literally getting 5 loans from 5 different lenders at the same time. Because unlike when you get a second mortgage on a house, when you get a second mortgage on a house, the document says all over it that would be a federal crime if you sign this as a second mortgage, but you already have a second, so it's a third. Okay, that is a crime for real. But getting you 5 loans on the same day that are $50,000 unsecured business loans, those are just loans. They don't say anywhere on there that you haven't applied or you haven't accepted some other loan.
And
No,
there's no risk associated with doing this other than overextending yourself,
that's the risk, of course. Yeah.
but no legal risk, no
No,
ethical risk. There's no,
no, no.
okay.
It's just a loan. But you could mess up your credit because it is after your business, it is personally guaranteed. And people
So,
come to me all the time and say, I have a business credit card, so it's business, so it's not personally guaranteed. And I don't want to argue with my clients, but I have to tell them the truth.
so
It
at that
is
point, it's
personal.
like, hey, you got 25 business credit card, you got, sorry, 525 business credit card loans. So now you are up to, 100,
125.
125. If you take all that 125 and you invest it in assets that can outweigh the liability, that's the trick, right? It's like I have a plan here to invest as long as you're not spending this money on stupid things that, or if you have a strategy in place and you need capital to prime the engine to get it going to invest in the assets, that's the way to look at it, right?
Sure, but it's easy now that COVID happened. So you take out, you come to me for 75, I get you 125. Doesn't matter what program or product, we get you 125,000. You invest it all in a restaurant of any type, and COVID comes back. Well, you didn't want COVID to come back. You had no control of that. But COVID comes back, you're personally liable because the restaurant's got to close.
Right.
Okay. So that's the problem, is that everything we're talking about is personally guaranteed. And we agreed to talk in another time about non-personal guarantee, which we now can do. But everything when I say conventional business loan, I don't want you to think it's conventional. You might be able to get a conventional business loan if you owned a business, but it might be 5 or 10 times larger if we do it than if you do it on your own. Through technique, through going to multiple banks in a particular order, through relationships, through whatever techniques that we can come up with. It's people are coming to us. We can get them usually 5 to 20 times what they could get on their own.
Got it.
So it's more about getting more or getting enough to actually start that business legitimately and not run out of money.
Got it. One thing I'm curious about, and I think we're getting close to the end of the conversation. Um, there are some loans I want to make sure we identify as stay the hell away from these loans. Don't touch them with a 10-foot pole. What are those precautionary, like, what are the loans we just do not want to touch?
Well, they're all fall under one category. They're basically a version of MCA. MCA is merchant card advance. And there are a ton of these newfangled companies offering basically merchant card advance under a different picture. And they're never going to call it merchant card advance, but it is an MCA loan.
What is a merchant card? Like, so merchant, I think of credit card processor. Merchant.
Yes. Well, here's how it works.
Or
Most of those loans are paid daily. Even if it's 5 days a week, it's daily. That's how you know. It's either weekly or daily. That's how you know it's going to be an MCA. That the hallmarks are, we'll give you a loan. We don't care how bad your credit is. We'll close today. We'll wire the money this afternoon. And you're going to have a daily payment. That's how you pretty much know it's an MCA.
right.
But here's how they kind of hide it a little bit. So do you know Stripe and Square? Are you familiar with those companies?
I am. I want to make sure before we get into that. So a merchant card advance, you'll identify it by whether it's paid weekly or daily, or if they can close today. Did I miss anything there? I want to make sure I'm taking notes.
They usually don't care how bad your credit is.
Okay. Um, so yes, I have heard of Square. I have heard of what was the other one? Stripe.
Stripe. Yeah.
And
Square.
also,
A lot of restaurants use Square.
yeah, and Post is another one that's I believe that offers these types as well.
So here's what's happened. A lot of those companies, because they are already tied to your bank and tied to your till or your credit card processing machine. What they do is they send you an email that says, you qualify for a $21,000 loan. Just type in here yes and answer a couple of questions, and we'll send you a $21,000 loan, a $25,000 loan, and you get the whole 25,000, and then they just take it out of your bank account. So they're basically doing an MCA loan, but you didn't go to a company that offers it. It's coming in straight through your processor, like Toast or Square or Stripe. So I'm kind of saying beware, because it really is an MCA loan, even though you didn't go out and find a shop that offers MCA loans, but you just received an MCA loan by an email directly from Square or Stripe, and you didn't realize what it was.
So help me understand this a little bit more. So I'm familiar with what you're talking about. Essentially, you have this credit card processor, much like Stripe is like for digital, like, hey, like this is like I have Stripe as a digital.
So do I.
Yeah, because I'm a digital creator. I need a way to take money digitally from my audience, whether you join my community or whatever. Or Payments AI is another tool that I use. So that is a credit card processing company. They collect the money, they take their cut, their service fees, and then what's ever left over gets deposited to your income account, right? But if you agree to the terms of the loan, they're going to take their cut, the service fee, and whatever percentage that you agree on out before it ever hits your income account.
What up, unstoppable restaurant owners and operators? We have to interrupt today's video to let you know that Restaurant Unstoppable and Restaurant Systems Pro, we're taking our relationship to the next level. Beginning in July of 2024, Fred Langley, CEO of Restaurant Systems Pro, is making himself available once a week in Restaurant Unstoppable Network to answer all of your restaurant systems questions, whether it's the profit margins. He will look at your P&L. Bring your P&L. He will take a look at that. He will dissect it. He will help you find your profit, whether that be through budgeting, inventory management, costing recipe cards, labor, checklists, you name it. He is a master on restaurant systems, and he's making himself available to you. Fred Langley and Restaurant Systems Pro started as a consulting firm, and for over 16 years, they've been helping their clients increase their profit by 10% or more. What are you waiting for? Click the link below to join our Facebook group, Restaurant Unstoppable Network.
That's correct. But what happens is they charge in advance and daily. So they make it so you can't compare it to any other loan, because it's not like I took a 10% interest rate loan. You can't do the math because they hide the math. Because
how do they hide the math?
Well, two ways. One is prepay. So basically, instead of paying for the use of the money at the end of the month, you're paying at the beginning of the month. So you're starting out upside down. You owe them. Not for the use of the money for the 30 days, but because you're going to use the money for the next 30 days. And then they charge you daily. So no one could do the math and figure out what the rate is. I saw one yesterday. One of my clients is going to sign one. He wants me to review it. I'm like, we don't offer them because they're so bad. So why do you want me to review it? It's just going to be bad. I guess you wanted to know how
restaurants
bad.
are desperate, because
yeah. But I call them restaurant killers. I've been calling them restaurant killers for years, but it's really not because it's the end of the world. In fact, I've put together a couple of MCAs reluctantly for a restaurant, and I make them swear it's a one-time only. They're never going to take it again. But it was, one of them wanted to add a balcony, and they gave me not a balcony, like an outside terrace.
Yeah.
And that whole patio setup was only going to be like $35,000, but the amount of seats it was going to increase the restaurant during certain types of year, and all of the, they're convincing me of all the benefits. And again, they don't have to convince me. My job is to get them the loan. But the fact that they were able to go through such an exhaustive description made me think they did really good research, So but it was
the risk, the cost risk benefit, or the pros and cons. Like they had a plan. It's a high risk but high return.
Right. But if you take the MCA and you say to yourself, I am going to do this once for the rest of my life, I'm never going to do this again, but I'm going to use it as what we call a bridge loan. Okay. So I'm taking it on January, and in March, I'm going to get rid of it. It's a bridge to get me from here to here, to get me financing, to get me the patio built before the summer starts, because that's where they're going to make the money on the patios during the summer months or whatever it is. So, but the general concept is you can't figure out what an MCA is going to cost you, but the interest rate, if you could interpolated, might be 35 to 70% or higher. So, but you can't look at the document and figure out what the rate is. It's
70,
hidden.
30%. What was that range? 30% to what?
70%.
Wow. That is the percent interest.
Yes, but you have to interpret that, because you can't do simple math because of this whole daily payments, 5 days a week, 20 payments a month. You can't do the math. But if it was a simple interest rate loan, it would say, here's the rate, and it would be so high you would never take it.
Got it. What about some of these other companies that have come out there that like, have you heard of Cabbage? Do you know Cabbage?
I have heard of Cabbage. I don't remember if Cabbage is MCA or not. I could probably check while we're talking.
There's another company. What the hell? There's Cabbage and another one that is similar, where from what I understand, they like similar to what you do, they use technology and artificial intelligence, I'm assuming, to basically scan the market for available loans. And but a part of what makes me think of this is they guarantee like within 24 hours, right? So
That's
that means
MCA. I'm telling you right there. That's how
so
you know it's MCA.
what is it on deck? I think is the
Oh,
other one.
On Deck is one of the biggest MCA lenders. When I say biggest, they do loans up to, a quarter million, half a million, $1 million MCA loans.
So
Yeah,
these are
that's an
those are
absolute. No, they're not hiding they're an MCA, but there's a lot of these new, what they're calling fintech companies, like Toast, uh,
where
Square, and Stripe are fintech, financial technology companies, but they're now offering these loans that are MCA, you know. But you feel more comfortable because you're not going to a sleazy broker, and they offered you the loan by email, so you kind of feels better. But let me tell you, it's still MCA.
yeah. So with an MCA, say on deck or Cabbage, um, they don't have they're not a credit card processor.
No, but they attach to, first of all, they look at your bank account, and their computer instantly analyzes your bank account because it's all about income. So the first thing to
All
do
about
is
what?
income,
Okay.
type of income, consistency of income. It's all about income. So they'll go back 3 months or 6 months. So they want bank statements, but eventually they're going to want your username and password for your bank account. And they connect their computer to your bank account, and they instantly can analyze your whole bank account. I mean, it's
Can they
literally is
draw from your account?
no, no. At that phase, they're just logging in and having their computer analyze. But it's
Got
a
it.
very fast way to analyze a bank account.
Got it.
In fact, more and more business banks are offering uh, temporary usernames and passwords, because people are using things like MCAs and they don't want to give their real username and password to their real bank account because they're afraid.
Right.
Uh, Trust me, Cabbage and
On deck.
those kind of companies like On Deck, they're already thieves. They're not going to steal your money. They're doing a legal version of stealing your money. They just want you to sign up, but
Yeah.
they're going to analyze your bank account, and it's really amazing because it can be done instantly now. Um, and you could always, what I tell my clients to do is just change their username, uh, leave their username alone, and change their password. Change your password to Michael123, let them analyze your bank account, and change it back to whatever your real password is.
Got
So
it.
now you could still remember your password. You don't
Right.
have to give them your real password.
Got it.
And and
Go ahead.
they literally are known for same day funding. That is their claim to fame.
So
You know?
that's a red flag right
Oh,
there.
that's a big
Where-
one.
Yeah. So I guess one thing I'm still a little uncertain about is how is a merchant processor like Square or Toast or Stripe different from a on deck? Because I
They
mean,
aren't.
they aren't.
They're not. But
one
on deck, you have
thing
to
that
go out and find where Toast just sent you an email saying, "Would you like a $21,000 loan? You're already approved."
But I think the other variable there is that with a Toast or Square, they can pull money out of, they can take the money from you. You don't pay them. That's a big difference, is it not?
No, same thing. When you sign up with On Deck, you're giving them permission to take money from your bank account every
Debit
single day.
every day.
Every day.
Okay. And
Yeah.
is it actually debit every day
Oh yeah.
at a rate
Well,
of 30 to
well,
70% of whatever the loan is?
again, I'm giving you the numbers because you can't look at their documents and figure out the numbers.
Right.
Okay. Because they're pre-charging you for the month, and because it's daily, you can't look at the loan and say, oh look, because you could look at the loan and it says 18%. Look, it's an 18% loan. No, it's not. It might be 30, it might be 70, but it ain't
Right.
18%.
So there are circumstances that come to my mind right now. If you are, again, this the focus of today's conversation is how to start and how to scale a concept. If you're looking to make big investments like a whole brick and mortar like piece of property, right? That's a big investment that you're not going to pay off in 2 months. If your walk-in goes down and you need to replace your walk-in so you can keep the money coming in, say that walk-in costs $10,000, and you know that you can make the money and pay off that loan, but you know that you'll make zero money if you don't have a walk-in. Like, is that an example of where you're like, I don't want to do this, but it's better than the alternative?
Yes, but only if you haven't started working with us. If you had started working with us, I'd make sure you had 50 or 100,000 in business credit cards that you were not using. So you would use the business credit cards for that situation.
Yeah.
But yes, that is exactly where you would use this kind of a loan, if to fix your walk-in the same day. Absolutely, that would be a great use, because you can, especially if it's the middle of your season. Let's say you're in the Hamptons, it's summer only season. You can't be closed more than a day, or you will not make it.
Yeah. I mean, I've had people on the show who have had good things to say about Square and their program to like get money. And I
I,
wonder if it's a
I'm
different program
Oh no,
or
no. It's the same. It's the same program. It might not be. It might be on the 30% side of that scale and not on the 70%. But I had someone tell me how wonderful On Deck was the other day, unsolicited. And I've known this guy, even though I don't talk to him often, I've known him for probably 10 years. But the best loan they have is not a fraction as good as other loans I could bring him.
right.
So it's a knowledge thing. He was able to use it when he needed it and thought it was great. If he had something directly I could compare it to, but if he needed money in one day and they came to him in one day, I don't have anything that can do that.
Right.
So for that purpose, it's great.
Yeah, that if there's like an emergency,
But if I get you business credit cards, there's your emergency fund.
got it. Got it. I hear you. Okay, before we say goodbye, up to this point, I just want to make sure summarize what we've covered. We talked about what are the types of funding for startup. In order, we recommend business credit card stacking, then personal credit card and or personal loans, SBA loans, and from there, if you're scaling, you've gotten open, you have proof of concept. We're looking at conventional business loans, and again, back to the SBA loans with 2 years of tax returns, profitability, stability, 10% down is basically what you're looking at. And then what you offer specifically where people miss the mark is that with an expert eye, you can go the business credit card route or business loan route and get compounded loans at once to maximize your ability to leverage assets to get that money working for you as fast as possible at low risk. And then the big takeaways in terms of predacious or loans to avoid, MCA loans, which stands for Merchant Card Advance. You see this manifest in services like On Deck and Cabbage, and or today with FinTech, Square, Stripe, Toast. Avoid those.
Avoid them if you can. Yeah, if you have no choice, of course, it's great.
Right.
But
Don't use those loans for scaling, right?
that's correct.
Long-term scaling where you're not going to be able to get the guarantee return. And, but over time you will. Like these are for like short-term. I need to replace my walk-in. I need to like this thing will
Same day.
business. Yeah.
Same day. That's a great use.
And just side note, never put yourself in that position. You should have some kind of cash flow management program where you're taking a percent of your total income, your total revenue, and putting it towards a profit account where you have a get out of jail free account if something like that happens. Like you do not want to be living day by day. The one thing I wanted to wrap up with today, you said more is better in terms of raising money. I kind of want to play with that last statement before we say goodbye. Uh,
Sure.
the number one reason why restaurants go out of business is because they are undercapitalized. They say, I need $100,000 to get going. Reality is, I need $200,000. That's just the reality of it. Whatever you think you need, double it. That's probably more.
Minimum, absolute minimum. Yes.
But that mindset of more is better, I think, also gets people in trouble. I think when you think of more, you think outwards. I need more this, more that. You're looking out and you're trying to find your solution out in the world. What I have found is that less is better in many occasions. Like, don't overextend yourself. Start small and have that vision, have that modest starting point, and let that small starting point be half of what you think you need. So you say I need $100,000. What can you do with $50,000? Start there. Get some kind of traction. Get something going, and then
Eric, I'm totally with you. Totally. I couldn't be more on your side on that one. I've got people that come to me for 100,000 and I say, well, I think I can get you 200. And immediately I'm going to do two of them. I'm like, how about do one and make sure that you could do it for 100,000 because it might cost you more. Right. It might take longer.
Or maybe you're like, I can get you 100,000, but I can't get you what you need. Start smaller. And I think what happens in this world, I think we see people who've achieved success and they have these visions of the restaurants they go to and they want to recreate those restaurants. But what they don't realize is that those restaurants have been around for maybe 20, 30 years. And what they are today isn't how they started. You have to it takes time to build that dream. And those dreams those big oak trees start with the seeds, little things. And don't look out and say, what do I need? Look in to what you already have. What can you get rid of? What liabilities do you have a car payment? Do you have a mortgage? Like, how bad do you want to be an entrepreneur? Get rid of all of your liabilities. Make it so every penny you make is going back into the business to scale. I think that the number one thing, less is more. Start small and then
improve it.
Yeah. And work on what you're already doing better, and try to squeeze as much juice out of that fruit that is your business as possible, to see if you can self-sustain it, to see if you can let cash flow determine your growth.
Mm-hmm.
What are your thoughts?
I love your approach.
Yeah. I mean, at the end of the day, we need money to grow, right? But I think that there is a line, there is a balance, there is a strategy. And I've seen a lot of people try to grow too fast. We were talking about that before we got started today, is that people think they have something magic in 2 locations or 3 locations. They say, let's get to 10 and it all falls apart.
Yeah.
So,
well, come on, it's harder to manage. How do you manage 10?
Right.
Managing 10 is a trick. Managing 1 is you being a good manager.
Right.
But, especially if they're different states. Can you imagine?
Yeah.
That would not be easy.
Michael, thank you very much for taking the time.
Eric, my pleasure.
For sharing your perspective.
And if any of your clients need help, just go to funding, and make a free consultation. They're all free.
Tell us one more time how it works. So you don't take any money up front. You get a percentage of, how does tell me your business model real quick.
Yeah, that's basically the business model, is that whatever we get you, personal credit cards, business credit cards, SBA loans, whatever it is, we charge you when you receive the money from the bank and not until.
Is that percent that you take on a sliding scale relative to your level of risk, or how does that work?
No, we're not at risk, but it's level of difficulty and size. So, we're going to charge a lot more for 100,000 than we are for 1 million.
Okay.
But what happens is a lot of people start with us at the bottom and they grow. So the client that came to me for 100, I got him 150. It might be 1 year, it might be 5 years, but 5 years later, I'm getting them $1 million loan. Again, sometimes that might mean $100,000 loans, not $1 million loan, depends on what it is. If it's an SBA loan, it might be 1 million or 2 million because we're buying a building now, so we're converting that to a real estate loan,
Got it.
which we love.
What?
Um,
Go ahead.
but we just charge when you receive money. That's when you pay us. You
What?
never pay us otherwise.
What is the what you call the type of business you are? Like, what category of, like, how do I label your business?
We consider it consulting, but honestly, we're just paid as a broker. We take fees only as a broker. That's why we've never been in trouble. We've never had a complaint in 15 years. How can you complain? You haven't paid us anything. And on a day-to-day basis, it's consulting. It's basically free consulting. We're going to guide you, teach you, show you, analyze you. And if you decide not to move forward, no hard feelings. We're friends forever. That's just the way we do it. I know it's different than anyone else, but that's the way we do it.
Got it. And if we want to reach out, what's the best way to connect with you?
Funding.com. Push the button that says schedule a free consultation. Everything is Zoom. At least the first, second, and maybe even third conversation is all going to be Zoom. At some point, we're going to move to applications, and then we're going to do three-way texts and emails. But in the beginning, it's all Zoom.
Got it. And I like to be fully transparent whenever I can. You weren't referred to me. You reached out. You said, "Hey, Eric, this is a subject I wanted to talk about." And I say, I have people who want to discuss this or are curious about this, but I don't have anybody in my network specifically who's been referred to me. So, I looked into you. We had about an hour conversation before you came on the show. I said, I feel good about this. And, this is a subject I frankly need to educate myself more on. So I look to get other perspective if you're listening to this. And there is something that was said today and you want to offer a different perspective, reach out to me. Let me know. I would love to hear different perspectives. But this is my attempt to open myself up to make myself stronger on this subject. And I really appreciate you taking the time to share your perspective and to reach out and to offer your knowledge. Thank you so much, man.
My pleasure. Thank you so much, Eric.
Cheers.